The stock market, so often referred to as the gateway to long-term financial safety and freedom, was not all sunshine and roses during the last year. And experts on the matter fear that the worst is yet to come. Today, we'll be looking at one of the most indicative financial factors of the last decade, with an estimated $18 trillion being completely wiped out of the global economy in a matter of 6 months. Welcome to All Finance Talk. Before we move on though, make sure to like this video and subscribe to the channel, and also turn on the notification bell so you can stay completely up to date with all financial talk. Now then, coming back to the topic, the first half of last year saw a retraction of market capitalization of 15% in comparison with the 6 months before that. Nearly all regions around the globe face similar trends. In the simplest of terms, most economists pointed to the Ukraine war as being the key reason for this steep fall, adding to the problems already piled on during the COVID pandemic. However, this approach doesn't explain why the trading in cash equities actually increased in the United States as well as the European and Middle Eastern markets during the same time. Let's look at the $18 trillion that were lost in 2022. Last year, the all-country world index dropped around 20%. To put it into context, the last time it dropped that low was right before the 2008 global recession. This has happened off the back of record-high interest rates hikes by Federal Reserve. It must also be noted that off the $18 trillion lost, $8.3 trillion was from the US market alone. While it is not common for the S&P 500 to fall for 2 consecutive years, when it does happen, it's usually far worse in the second year. To see how 2023 fares for the global economy, a few factors must be taken into account. The year 2022 was a disastrous one for the tech giants. The Nasdaq 100 index, which is seen as the stand-in for tech companies, slumped 35% during the course of last year. The companies of Meta and Tesla both lost nearly 2/3 of their valuation, contributing greatly to the $18 trillion losses. Even companies like Amazon and Netflix lost more than half their value in 2022. This was not unforeseen, since tech stocks of that magnitude usually tend to lose value whenever there is an increase in interest rates. The economic slump of the recent times has also meant that the demand for smartphones has slumped. This has particularly affected Apple, which saw the demand for the iPhone go down. Supply chains across the globe were affected due to COVID regulations, and the iPhone was no different, meaning that low supply was coupled with high prices. This low demand goes beyond smartphones, as it directly affects online advertising negatively. In a scenario like this, tech manufacturers like Apple and Samsung will lose value, and the online space, dominated by giants like Meta and Alphabet, also shrinks, which negatively affects their value. This loss in trust for tech companies was also reflected in Bloomberg's annual survey, which revealed that over half of the respondents no longer felt as if the tech stocks can make a comeback in 2023. Another factor that contributed to the $18 trillion debacle were the situations arising in China. The biggest market in the world is also facing the ravaging new issue of rising COVID infections, as a new variant has forced the Beijing government to revamp restriction efforts. Countries around the world are demanding Chinese travelers to face COVID tests again. Chinese tourists contribute hugely to luxury, travel, and leisure stocks in the US and elsewhere. These stocks have been falling considerably, at a time when Chinese firms are already finding themselves back into restrictions. All in all, Chinese stocks lost about 24% of their value in 2022. The sheer magnitude of their market meant that any drawback for Chinese stocks would adversely affect markets around the world, and thus it was a major contributor to the $18 trillion wipeout. The talk of a possible recession is very much in the air. The drop in the Nasdaq 100 by more than 20% has only happened on 11 occasions in history. 9 times out of that, a recession followed. And with a $3 trillion drop in tech stocks from the S&P 500, you would not be wrong for freaking out. The massive drawdown has already led to liquidations on the Wall Street. Experts blame the hawkish monetary policy of the Federal Reserve for this, and have warned investors that until the Fed works with central banks for a newer policy, the free fall won't stop. With $9 trillion gone from the American households in 2022, this creates a scenario of limited spending. Altering of the spending patterns on this massive scale eventually leads to lower cash reserves for firms. This will force the firms to lay off employees in an effort to conserve working capital and avoid liquidation. The massive layoffs in 2022 include the 30,000 employees let off by Amazon, and the 13% of all workers in Meta being let off. The cycle comes full circle when people reduce spending due to the fear of potential unemployment. If the cycle continues long enough, and incorporate more and more sectors, the perfect boiling pot of recession brews unchecked. Companies lose more and more value as the demand for their stock plummets, which is bound to happen due to the conservative spending patterns across the board. Perhaps the final piece in the wipeout puzzle was the Ukraine war, which disrupted supply lines across the globe. Sanctions, trade block-offs, and warfare played host to a number of issues, as global giants rely on Russia and Ukraine for neon gas, platinum, and palladium. When it comes to neon gas, the two biggest suppliers in the Ukraine, Cryoin and Ingas, halted their production as a result of the Russian invasion. This has affected 54% of the entire world's neon consumption, which is used to manufacture chips in computers. Technology hardware firms, including laptop, smartphone, and even automobile manufacturers have faced stringent supply. The downturn reduces the firm's revenues, profits, and contributes to the wipeout of company value. Russia is also a key producer of oil and natural gas, meaning that cutting the country off will halt energy supply in key Russian buyer states like Germany. The energy price hikes eventually pass on to consumers, and German citizens saw 17.1% higher prices for consumer goods in 2022 than in 2021. This will play on to lower spending and firms losing value. Overall, the Ukraine war affected 12% of the entire US economy adversely, and shrinking the global market. These factors all combined to brew the conditions that led to an $18 trillion wipeout globally. Seeing the conditions at hand, it is no wonder that people ask what they can expect in 2023. In the short term, the investor community has nothing to be optimistic about, as all indicators point to a downturn. The situation looks bleak for nearly the next 18 months according to experts. In simpler terms, it's not about if the recession will hit, but rather how adversely it will affect the global economy. That brings us to the end of this video. We hope you enjoyed it. Once again, make sure to like and subscribe to keep updated, and thanks for watching.